Welcome to vTalkInsight, Allocator's lens daily for February 18th, 2026. Cross-asset signals are pulling in different directions, with equities under pressure, bonds rallying, and volatility gauges sitting in the low 20s, even as growth and earnings data stay broadly supportive. The key question for allocators now is whether this is a healthy rotation away from crowded trades or the early phase of a more persistent de-risking episode. Let's start with equities, where the tension between strong fundamentals and a tech-led reset is most visible. Equities are feeling the strain from a renewed risk-off tone, even though the macro backdrop still looks constructive. Major growth benchmarks, including large U.S. technology indices and European blue chips, have been drifting lower, and smaller U.S. companies are also lagging, all against a backdrop of a volatility gauge around the low 20s and a recent stall after the post-inflation data rally. This sets the stage for a market where fundamentals and price action are increasingly out of sync. At the heart of the story is technology and the AI trade. Heavy capital spending on AI infrastructure is squeezing free cash flow at some mega-cap names, which, together with record high corporate capex and worries about overinvestment, is feeding valuation anxiety. That is showing up in performance. Semiconductor stocks and memory producers have generally held up better since last year, while software, especially industrial and design software in Europe, has sold off as investors question how defensible those business models are in an AI world. Expectations around upcoming earnings from major AI hardware leaders have been reset lower after recent underperformance. So the bar for a positive surprise is now easier to clear, but any disappointment could trigger sharp single-name moves. Under the surface, though, the equity picture is not uniformly negative. Market breadth has improved, with equal-weighted benchmarks pushing toward record levels and median earnings growth across a broad U.S. universe accelerating into the low double digits, well above last year's pace. Financials have started to outperform big tech, helped by record revenues at large banks across trading and advisory businesses, while deal activity in sectors such as media and medical technology underlines that animal spirits are still alive. Regionally, capital is drifting away from the most crowded U.S. AI names toward markets with more reasonable valuations and supportive policy backdrops, including the UK, parts of Europe, Japan, and Latin America, where expectations of rate cuts and fiscal spending on infrastructure and defense are seen as tailwinds. Sector dispersion remains extreme. Basic resources in Europe are underperforming, weighed down by weaker guidance and softer precious metal prices, even as select miners with strong copper exposure report robust earnings and upgraded production plans tied to electrification themes. At the same time, IPO activity has rebounded sharply, with new listings seeing solid high single-digit first-day gains, pointing to a reopening of public equity risk appetite despite index-level hesitation. For a cross-asset allocator, the equity message is that the cycle still supports risk, but leadership is rotating away from expensive, AI-centric megacaps toward more reasonably valued regions and sectors. The key watch points now are upcoming AI earnings, the sustainability of broad earnings growth, and whether elevated volatility stays contained to equities or begins to bleed into credit and currencies. Turning to rates, government bonds have reasserted themselves as the main shock absorber in this environment. U.S. Treasury yields have moved lower, with the 10-year dipping just below the 4% area and the 2-year dropping back toward levels last seen in 2022, as markets build in the possibility of around 3 Federal Reserve rate cuts this year. Flows into long-duration U.S. debt have accelerated, with long-maturity bond funds staging their strongest rally in months, and the correlation between stocks and bonds has turned more negative again as inflation volatility has eased. That makes Treasuries a more effective, if still imperfect, portfolio hedge than they were a decade ago. But beneath the rally, there is real disagreement about the true stance of policy and the value on offer. On one side, some argue that with inflation still hovering near 3%, current policy rates may not be as restrictive as central banks intend, and that yields below 4% do not provide enough compensation given concerns about persistent deficits and inflation staying above target. On the other side, others highlight that real yields of roughly 1.5 to 2 percentage points above inflation still look compelling and could keep demand for fixed income strong. One large manager expects the U.S. 10-year to trade in a broad range between just under 4 and just under 5% through 2026, and signals less enthusiasm for holding long duration when yields sit near the bottom of that range. Outside the U.S., rate expectations are moving quickly as well. In the UK, softer wage growth and weakening labor data have pushed gilt yields down and left markets assigning a high probability to a Bank of England cut as soon as March, with inflation projected to drift toward the 2% target later this year. German government bonds continue to act as Europe's core safe haven, while French debt still trades more like a peripheral asset with persistent spread risk tied to fiscal perceptions and politics. In Japan, yields have also fallen on expectations of fiscal support, even as investors stay alert to the risk of higher bond issuance over the next few years. The main risk to the current bond-friendly setup will be either a renewed inflation surprise or growth data that invalidate the need for early easing. Conversely, a sharper slowdown would likely extend a rally and deepen the negative stock-bond correlation. In credit, public markets still look remarkably calm given the pickup in equity volatility. Spreads remain historically tight, even as idiosyncratic risks in equities and sovereign debt worries have risen, suggesting that credit is still priced for a relatively benign economic outcome. Some managers favor high-quality, investment-grade bonds, pointing to somewhat wider spreads and robust corporate revenue profiles, while remaining cautious on high yield and preferring to see an additional 100 to 150 basis points of spread widening before feeling more comfortable with lower quality risk. The combination of tight spreads and improving leading indicators, such as purchasing manager indices above 50, reinforces the impression that the credit market continues to lean toward a soft landing scenario. However, pockets of stress are emerging under the surface. In U.S. technology-focused leveraged loans, distress ratios have climbed into the mid-teens, signaling growing pressure in parts of the capital structure that funded earlier growth stories. So far, this has not translated into broad contagion, in part because private credit markets have absorbed some refinancing needs and provided buffers away from the banking system. But it does highlight that credit risk is not evenly distributed. Managers with less exposure to software and highly valued tech borrowers have, for now, benefited from the recent sector volatility. At the same time, private credit remains in high demand, especially for funding large AI infrastructure projects, with sizable capital pools from insurers, investment-grade buyers, and dedicated private lenders all seeking exposure to that growth theme. The gap between public and private credit in terms of pricing and documentation is narrowing, giving companies more flexibility in how they raise capital, but also increasing the interconnectedness of the two markets. Diversified private credit strategies, spread across geographies and sectors, are expected by some to be better placed as the market matures and competition intensifies. From an allocator's perspective, the key risks to monitor are whether volatility in AI and tech eventually feeds into default rates, whether high-yield spreads begin the kind of widening that many have been anticipating, and how sovereign spread stories, like France versus Germany, evolve alongside this credit cycle. In foreign exchange, the clearest signal comes from the UK, where the pound has softened following weaker labor market data and wage growth that undershot expectations. That has encouraged markets to price in a high likelihood of a Bank of England rate cut as early as March, and at least a couple of moves over the course of a year, reinforcing the perception of a more dovish policy path compared with some peers. This shift in rate expectations interacts directly with UK assets, supporting equities that benefit from lower discount rates, such as house builders, while pulling international capital into gilts as yields compress. In contrast, China's currency is expected by several strategists to appreciate gradually, despite domestic economic softness, thanks to a still strong external sector. That makes the renminbi a relatively high-conviction view in the current landscape, and it fits with the broader theme of slow diversification away from the U.S. dollar scene in recent sessions. Traditional defensive currencies and assets, including the Swiss franc and gold, are described as expensive, and there's a sense that gold in particular has become a less reliable instant hedge, encouraging allocators to think more flexibly about how they construct downside protection. So far, despite the pickup in equity volatility, major currency pairs and even crypto benchmarks have moved less dramatically. But the risk is that a deeper growth or policy shock could pull FX more squarely into the adjustment process. Commodities round out the picture with a mix of short-term reversals and longer-term themes. Gold has seen a sharp price drop, with an intraday fall of over $80 per ounce and a break below a recent psychological level, suggesting that some safe haven and speculative positions have been unwound quickly. Yet several medium-term forces still look supportive, including sustained buying from emerging market central banks that are diversifying away from treasuries, and a view of gold as a useful portfolio diversifier with an inverse cyclical relationship to equities. The tension is that traditional hedges like gold and the Swiss franc are now seen as expensive, and gold's day-to-day effectiveness as a safety asset has become less predictable, implying a choppier, more path-dependent return profile, even if the broader trend remains constructive. In energy, Brent crude has fallen by more than 2.5% on the back of tentative progress in nuclear talks between the U.S. and Iran, which has reduced immediate fears of supply disruption. Those negotiations are far from resolved, and broader geopolitical tensions, including the ongoing Russia-Ukraine conflict, keep the medium-term risk premium alive, but the latest move underlines how quickly crude can react to even incremental diplomatic signals. For allocators, oil remains a key channel through which geopolitical developments can spill into inflation expectations and, by extension, into rate and equity pricing. Industrial metals, especially copper, tell a different story. One of the world's largest miners has reported that copper now contributes more than half of group profits, raised production guidance at a flagship Chilean mine, and outlined expansion projects across the Americas and Australia, all framed by a constructive demand outlook tied to electrification and infrastructure. That has offered a positive read across for some copper-exposed miners, even as the broader European basic resources sector underperforms on weaker guidance elsewhere and softer silver prices. The divergence between strong copper fundamentals and weaker listed resource equities is worth watching as a barometer of how much confidence investors really have in the durability of the growth and energy transition story. Stepping back, today's cross-asset picture shows equities wrestling with an AI-driven reset and rising dispersion, rates markets leaning into an easier policy path, and credit still priced for calm despite clear pockets of stress. In foreign exchange, sterling softness and expected renminbi strength underline policy divergence, while in commodities, gold's whipsaw, oil's sensitivity to diplomacy, and copper's resilience all send mixed but important signals about growth, inflation, and hedging. For allocators, the key is to watch whether volatility remains contained to crowded equity themes or starts to challenge the current optimism embedded in credit and parts of rates, and how upcoming data and earnings either confirm or undermine the soft landing narrative. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.